for, a race to be so, so concentrated. And, one of the questions that I sort of get is, a lot about is swing trading within the racing markets. I try and keep the process as simple as possible. There's many ways I should imagine that people will attempt this discipline, but I'll just sort of explain a little bit how I attempt to discipline. And I just keep the thought process pretty short. Now I target, as you know, Gareth, I will target for the movers is below 3.0, and one is the increments in the ticks. Okay. On those particular races is, i.e. 15 ticks is going to lose 10%. And that's roughly, what I recommend that you work. So if you put £100 in, you're risking just £10. But it's where novices sort of, fall down is when something's, within a range. And what you can do, listeners, as a benchmark is, when it's below 2.0 and it's 1 point something, think of a 0.1 range. Okay. So the range might be 175 to 185. Okay. The middle ground, 180. Just think about the price points. Okay. That you get from the courses. Okay. Generally have in your mind that it's most likely going to, a lot of the time, these horses, you do get the big steamers, but you get some that will settle within 2 price points. Now, when you get, say, between 2.0 and 3, be 0.2. So, the price range might be 2.54 to 2.74. Okay. And that's your range. And the horse is going to swing within that particular range. Now, sometimes it may only get to the middle ground, which is say 264, and then bounce back. It may not go the full range. Okay. So as once you've identified a range, and if you do as a starting point, and you've got to be flexible here as the price moves. Something like 6 to 4, 2.5 is most likely going to trade around about 2.58 to about 264 on Betfair. Okay. 262, 13 to 8 is going to trade almost up to where 7 to 4 is going to be. Okay. So there's your 2 price points within a range. So once you've identified a range, is that the process is quite simple. So say, you've identified this range 254 to 274. Okay. You're not necessarily always going to get at the top of the range, because you've got to wait for it to start coming back down. You've got to wait for the money to dry up, on the lay side. Sometimes it may go through, and that gives you better opportunities, and you may want to be speculative. But let's say, for instance, you've identified the opportunity, it's 2.7. You've put £100 into the market. Okay. You'd put your stop loss at 3.0. That's going to mean if you put £100 in, you're risking £10. Okay. Say it trends all the way down to the bottom of the range, 2.54. Okay. It's got at the bottom range and it's turned. To close your position, and this is where many novices traders will go wrong, is that they'll just take the green book and say, well, fantastic. Look how good I am. I've done this trade. It's within there. They don't have the confidence then to play the swing. What on your closing position will be a £200 trade. Okay. So you're closing your £100 down your original bet. Okay. And then you put in a £100 lay. The reason you put in another additional lay into the market is you think that the market's going to bounce the other way. What you do with your stop loss is you put that in a scratch position. Okay. So sometime below that 254 that you're getting in, there will be a price point that means if the market continues to go in, the worst case situation is you're going to be completely at scratch. Okay. This is a perfect race. It's swinging. It goes back up towards, the 2.74. The market changes. You would then reclose your position again with £200. Okay. So you close in the £100 that you've got to lay, and then you put another bet at 100. So effectively you're trading for £100, but once you've done the first trade, either the top or the bottom at 100, you're always doubling the money that goes back in. Okay, because the reason that you're closing is you think the market's changed. Again, your stop loss might be at 3.0, but once you've made 2 successful trades, you're only risking the profit then that you made on the second trade. That first trade's locked in. That's guaranteed from that particular point. Now, in races that it's swinging, within a range. You can get 4, 5, maybe 6 trades within a 10-minute period. And each time, if you're playing it correctly, you're compounding that up. The only difference where you don't necessarily do that, where you close in a position and an opening on the other side, is if it gets to the middle ground, okay? If it stalls at the middle ground and then bounces back, what you do is you just close, okay? You just close with that £100, let it go back to the top of the range and then back in, okay? And, once you've identified a range and you've set the middle ground, is as long as you're not entering the market at that middle price point, so say in this example 264, as long as you're not backing at 264 or laying at 264, if you're laying below that, the closer you get down to the bottom of the range, the bigger the profit that you're going to get, and the closer you get to 274, the bigger profit that you're going to get as it bounces down. Most cases, as you get more experiences, that middle ground that you identify, once you become successful in identifying the ranges, is most likely the price that horse is going to go off at. And a sort of telltale sign, as you sort of, building this profile, is you'll see that as clear as crystal. And that's where the volume of money is being matched at this price point, because the market keeps returning to this middle ground, okay? And, that's how I approach swing trading. Is initially have that thought process, could be a 0.2, okay, and that gives you 2 price points within the live shows, okay. If it goes through your price, it goes below 254 to 244, the chances are it's moved a different price point on the course. You just match that up and be flexible. You just move it down. Your price range might be 244, then to 264 as it ranges. It will generally just stick, not religiously, but I would say 7 times out of 10 within this 0.2 of a range of horses that are trading below 3. So I hope that's explained a little bit about how I approach swing trading or horses that are trading, within a range. Is keep that process simple. But the key factor is when you've identified that, when you're closing a position, is that you've got to be opening up on the other side with a position as well to get it back the other way. And once you've made your first successful position, even if you get your second one wrong, completely wrong, in practicing, you've got a stop loss at scratch. It's not going to cost you any money, okay? But you'll learn a great deal, from the markets and that. But that's basically pretty much it with the swing trading, and how I sort of teach that aspect in the movers, would you say, Gareth?
Yeah, totally. The bounce factor and getting on the other side has helped me massively in that. So, yeah, that's the thing. It's quickly identifying it and putting that next trade in, and then just greeding up for your profit again. You get a double whammy, aren't you? So, certainly helped me, and I know a lot of the other guys massively, that sort of technique. So, yeah,
it's, novice traders can be very inflexible with the profits. They'll have, I want 10 ticks profit. And that's not necessarily, the stage. And when we get through to the IPL, I'm going to teach people to trade. We've got a method called 40-20, which is very, very successful on its own merit. But when you trade that dynamically and make the decisions, it can relate into a very, very big bet. Okay. Traded well. And it depends on your decisions. Is that many novice traders is right. I've put this money in. I've got my stop loss at 15 ticks, and I want 12 tick profit. Okay. The reality is you've got to be a little bit more flexible with your profits. If it hits those 12 ticks, is make a decision. Okay. And the decisions is this market going to go further? Yes or no. If you don't know, then just take what's on offer. Okay, because you don't know where the market's going to go. You're unsure. If you're getting out of the market because you think it's going to go the other way, you've got to be putting your money on the other side, because that's your decision maker. The reason that you're getting out of the market is because you think it's going to bounce back to where it was. So you've got to play that. But once you've made that first successful trade, then you're in a position of strength. So you can relate swing trading into any situation. Okay, it might be a wicket in the test matches. It forces the price down to 1.5, and you notice, well, yeah, if they get a start, 20, 30 runs, this is going to bounce up to 1.6. Okay, you might be sort of playing that, And then you're just assessing it as it gets to these other price points. Well, okay, I know if there's another wicket, it's going to bounce down to 1.5. You just put a stop loss at scratch and say, well, actually, these are pretty set. The ball's got a bit softer. If they carry on, if they get another 40 runs without losing a wicket, it's going to move up to 1.7. And you just do it in little segments like that, constantly making decisions. And that's where the flexible approach, once you get into a position of strength, you've got to be inflexible with your stop losses, okay? So, whatever your risk that you're putting in the market is, if you're laying at 1.5 and you say, well, actually, I want to risk £80, okay? The more money that you put in if you put 1,000 in the market, you're moving at £10 a tick, then the reality is you've got about 10 ticks for your red book. If you put in 500, you're going to have between 16 and 20 ticks. So you can let it go to 1.3. So, find out what you're prepared to risk, find out your stop loss, and be, inflexible with that. If that hits within the first minute, then, take it on the chin, review, evaluate, where you're in the market to what caused it to go there, because that will give you instructions, for future trading. And that's the principles that I've adopted across all the sports that I trade. Is I find out how much I'm prepared to risk if I put the money in the market, and the reason I'm putting it in the market is I work out, the X, Y, and Zs of where it's going to go, and then you can relate it to a bet, because what you're betting is that's going to happen rather than that. Okay, so if it might be a breaker serve, it might be break points, it might be the broken serve, and if it goes on to win the set, it's trading at 1.4. If it goes on to win the set, it's only going to be 1.36 anyway, and there's still at least another 4 or 5 games in the set. It's not a big downside, but if it gets break points against him, above 30, then it's going to move 20 ticks in your favour. And then it now becomes, then once that happens, is how quickly you assess, amongst the points of whether to get out or whether the momentum is actually with the other player and they're going to actually break serve. And that all boils down to, knowledge and experience, et cetera, et cetera. But, it's be flexible with your profits. And if you're closing because you think the market's going to move the other way, then get on the other side, because you're leveraging profits. And if you set your stop loss at scratch position on those profits that you've already got from your first successful trade, then, the more of those that you go through a game, and if you take a 20-20 game where you can, chances are you're going to make, if you know the game, 5, 6, 7, 8, 9, 10, even more successful trades. Those small acorns from the beginning can really compound, where you're playing for big numbers, at the back end, and you're just playing with your profits. It's just a little bit food for thought, on that score. So, I get lots of emails. If you want to drop me a line for subjects to talk about, then, feel free at Matt, MATT, at proxtrading.com. Well,